everybody, it's Dave. It's Friday, February 27th. This is the last trading day of the month. I am here with my good friend Greg Newton of Naked Shorts. Greg, how you doing?
Doing good, Dave. Hi, everybody.
Well, the news today was, of course, the Citigroup news, with the government converting their preferred shares to common shares and putting a little more money where they're going to own. And then the Pandit said afterwards that takes any worries of nationalization off the table. You know, it's trading less than like $1 something, so it's a penny stock just about. It may take nationalization off the table, but it certainly doesn't take bankruptcy off the table. The financials are now only constitute, as of yesterday, 7% of the S&P. What do you think it was before?
The market itself topped in October 2007, but financials peaked in, I believe it was February 2007.
Yeah.
So, but they were at that point just over, I believe, 20% of the S&P 500. So
yeah, and I think the next biggest sector is what, energy?
Yeah.
But GE finally bit the bullet and cut its dividend today, and that hit that stock pretty hard. Which reminds me, Siegel,
yes,
he's in the business. He wanted to create an index, removing all financials from the index, and then moving his exchange-traded funds, removing all financials from them. So I don't know how Wisdom Tree, which had started as a dividend focus, I mean, the dividends are down and getting removed, and it hasn't had a good effect on their assets under management.
Yeah, I think there's a couple of interesting things we can look at for the macro picture. One stage this morning, the futures had the Dow just over, I believe it was about 7,020. So we nearly traded with a 6 handle on the Dow today. For the Dow and the S&P 500, they've just put up 6 consecutive losing months, which is something that hasn't happened since basically before my parents' time. So that's going back a haircut or two. There is one interesting thing going on. The bulls, who are always among us, are clicking their heels and pointing out that the NASDAQ, in fact, did not got anywhere near, in fact, its November lows. This is a bullish sign. One of the advantages the NASDAQ 100, of course, has is that it has no financials in it. So it has not suffered these last 3 months as badly as the two main indexes have, but it's not done that well either. And 1300 or wherever it is now, it's still 75% off where it was in March 2000. So let's just not go too nuts over stocks.
Well, they did have a good day today. I mean, some of the four horsemen picked it up a little bit, and Cisco was strong, and Intel and Dell, you know, they had good days. But the only thing that I think is doing well in that whole area is Amazon. The other important thing, of course, is that on the S&P, we took out the intraday low from November, which was at 741. And now we're at 735, so we've made new lows. Important to me, of course, is that the monthly RSIs are still way below 30, but even more importantly is that the Mark 9 has now been what's called perfected. Theoretically, we should get some kind of, over the next 4 months, either some sideways movement or maybe even some kind of counter-trend rally. Why that would happen is totally beyond me, but I just follow the tape.
Yeah, no, I think that this DeMark indicator is actually reasonably important because it's going to give the technical traders something to look at. We see these vicious rallies within bear market.
Intraday trading ranges are huge.
Yep.
We had a bear market rally on Tuesday.
Yes.
Down 250 points on Monday, up 250 points on Tuesday. So it's so difficult to take a position and maintain a position in this environment because the stops get hit and your risk levels are just way, way too high. Greg, let's talk a little bit about the uptick rule. You know, I've read some articles recently that talk about reinstatement and how important it is. Explain to people why it may not be that important.
This is something that makes me absolutely nuts because it's just a smokescreen. The uptick rule, for people who aren't familiar with it, was that until the middle of 2007, there was a rule which said that stocks could only be sold on an uptick. So that, for instance, you wanted to sell something short, you ended up selling it short at a higher price than at which it last traded. Back in the day, it may have had some impact because when stocks were being traded in eighths and you were getting a 25-cent spread, although there was a lot of academic work done which showed that even then the uptick rule had no real impact on people being able to get shorts of. Then in the early 1990s and the advent of SPDR, the first ETF, one of the things that made that equal was an exemption from the SEC because the basket was composed of 500 stocks that it could be shorted traded without an uptick, because the argument was that doing a basket like that would not have an impact on any particular stock in the market, and it couldn't be used to, quote, manipulate, unquote, the market. Since then, we've seen decimalization. Stocks are traded in pennies now. Even if you're looking at a level 2 tape going through, even in a market decline, you will see numerous upticks within the space of a minute. So those shorts are going to be able to get executed anyway. So, because what people often forget is the uptick rule only applied on the New York Stock Exchange anyway. It did not apply on the NASDAQ and the third markets.
Yeah, not to mention what's going on in ARCA and so forth.
Yeah.
And overseas and in futures markets and options markets and what's going on in all those areas.
Well, that's the point that I was trying to make last year when the SEC was jumping in and doing all these silly things, which even Christopher Cox admitted was the biggest mistake he ever made as chairman. He said was putting in that uptick, was cancelling the ability to short financial stocks in the crisis last year. Even he was smart enough to see he made a mistake with that. But the point that I'm getting to is that there's a million ways these days to get off a short stock position. The market with options, single stock futures, and ETFs, and all the other instruments that are out there, the uptick rule has nothing to do with what's going on. The issue is that the decision to cancel the uptick rule was made in mid-2007, almost right at the peak of the stock market, and obviously since then we've been in a bear market, so people are seeing a correlation that has nothing to do with causation. Mm-hmm. The reason that stocks are going down is that they were overvalued and their future earnings are currently seriously impaired, which if you look at Citigroup today is probably even not yet fully reflected in its stock price. It's got nothing to do with artificial market constraints.
Let's finish up with talking about bonds were down. We had $94 billion in auctions this week. Supply is going to push prices down and yields up. And even on a day like today when stocks were down and the news was bad and economic news was bad, bonds were weak. The dollar is stronger because there is so many problems going on in Eastern Europe. Yep. There's dollar demand because there's big trouble in Eastern Europe and perhaps other places as well. The EU has to step in. The problems that we face, I think, is the major thing is we just don't know how big the problem is. And there isn't a lot of transparency. And so, like Citigroup, what do we know about really what's going on within Citigroup other than it can't be that good, right?
Absolutely, and that is the problem. Nobody has yet come up with a way to value this stuff. There are bids out there for it, but the banks don't want to sell it for that because they've still got it marked in their books at 90 cents on the dollar. The bids they're getting are, the good ones are 30 cents. And it's not just mortgages, certainly not just subprime mortgages, it's mortgages of all kinds where conditionings are worsening. The other stuff they have big quantities of is CLOs or collateralized loan obligations, which are the securitizations of the various private equity deals that were done over the last 2 or 3 years, and we all know how well those are working out. A lot of people are talking about, well, why don't we just do a Resolution Trust Corporation? Problem is that this is one of the things they're having trouble getting their heads around, and until someone is brave enough to grow up and say, I have hung on to this garbage for 2 years because I hope that it might come back to where I've got it marked, but in actual fact it's still just getting worse. I mean, the banks are like bad traders. They're not taking their loss.
It's not going to get any better because people don't know what the extent is that everybody's sitting on. So it seems to be this postponement of the inevitable. Last but not least, we should talk about gold. Went up and tagged that $1,000 or thereabout price again. Been drawing these double tops, which I thought would probably attract some profit taking after the nice little run we've had. We're back to where we were about 3 weeks ago. The case for gold is a very strong case. Conspiracies and everything else aside, I don't know if it seemed likely to be just profit taking, because I just don't know of another investment that's worth getting involved in with all this uncertainty. What do you think, Greg?
Yeah, I think that $1,000 peak, we saw it in March last year. It hit $1,000 and then backed off. We hit it last week, I believe, and it's backed off again. It's off less than 10% from that $1,000 price, so it's not even a correction yet. We saw a bad print of $1,000 and then it went away for a couple of weeks before it came back and went right through it like a knife through butter when it finally got there. So these round numbers are always going to be serious resistance points.
Yeah, and, he means $100 on the oil, folks. But
oh, I'm sorry, yes.
So, folks, I think that'll wrap it up. Greg, thanks for being with me.
Oh, my pleasure, Dave. Thanks, everybody. Talk to you next week.